Hello everyone, my name is Albertus Rido Ariyadi. Today I will discuss the subject of income tax and the object of income tax. The subject of income tax, PPH, refers to individuals or entities that have the obligation to pay tax on the income they receive or earn. This is regulated by Law Number 36 of 2008. Which provides a legal framework for taxation in Indonesia. Income tax is an important source of state revenue, as it supports various development programs and public services. A good understanding of who falls under the category of tax subjects is crucial to ensuring compliance and fairness in taxation. According to the law, subjects of income tax are divided into three main categories. First, individuals include those who reside in Indonesia or those who have been in Indonesia for more than 183 days in a year. This criterion emphasizes that a person's physical presence in Indonesia contributes to their tax obligations. Second, the category of entities includes various legal entities, such as corporations, limited liability companies, and cooperatives that are established or operate in Indonesia. These entities are taxed based on the income generated from their business activities. The third category is undistributed inheritance, which refers to the assets of a deceased person that have not yet been divided among heirs. Even though it has not been distributed, this inheritance still generates taxable income. In addition to these three categories, tax subjects are also distinguished between domestic and foreign tax subjects based on their place of residence and sources of income. This distinction is important for determining the tax obligations that must be fulfilled and for providing clarity in tax management at both national and international levels. Over time, income tax revenue has become more dominant compared to revenue from other tax sectors. Income tax consists of corporate taxpayers and individual taxpayers. Generally, income tax revenue in Indonesia is still dominated by corporate income tax, as registered entities are easier to identify, monitor, and detect in their activities, making tax collection from corporations more optimal than from individuals. Meanwhile, collecting tax from individuals faces challenges in monitoring and detecting taxable income due to a lack of financial transaction information for each person. Essentially, income tax is an official levy imposed on the community that earns income or on income received or obtained during the tax year, for the interests of the state and society in nation building and governance, as an obligation that must be fulfilled. The object of income tax encompasses all forms of income received by tax subjects and serves as the basis for imposing income tax. According to applicable regulations, this tax object includes various sources of income that can be generated by individuals and entities. Common sources of income include salaries and wages received by employees, business profits from entrepreneurial activities, and interest earned from savings or investments. Each type of income has distinct characteristics and tax treatments that taxpayers need to understand to ensure proper compliance. In addition to salaries and business profits, the tax object also includes dividends received from stock ownership, royalties earned from the use of intellectual property rights, and gains from the sale of assets. Gains from asset sales can include the sale of property, stocks, or other valuable assets. Prizes and lottery winnings are also included in the tax object, where recipients of certain prizes may have tax obligations depending on the value of the prize received. That concludes my presentation. Thank you.